Hello. So we are on to derivatives L1 and we are going to learn more about option trading strategy. We'll see lots of strategy in brief details. So I am instructor Prabhat Kumar and I represent Investors Delight. And here we are going to talk about option trading strategy in details. We have already covered payout of call and put options. Now we'll see how combinations works like covered call, married put, bull call spread, bear put spread, protective collar, long straddle, long strangle, long call, butterfly spread. So all these strategy we'll discuss in brief details that will give you exposure to various option trading strategy and you will be able to take more challenging option trading strategy for your real trade. So option trading strategy, as we outline here, we can say there are many option strategy that both limit risk and maximize return. With little effort, traders can learn how to take advantage of flexibility and power that stock options can provide. Options trading is used to enhance return, bet on the market's movement, or hedge existing positions. Covered calls, collars, and married puts with existing positions. Spreads involve buying one or more options and simultaneously selling another option or options. Long straddles and strangles profit are such examples we'll explore now. So covered call. Coming to the covered call, let us see when is covered call used. So this is used often employed with investors has a short-term neutral to moderately bullish view on the stock he holds. He takes a short. If the stock price falls to zero, the investors loses the entire value of the stock but retains the premium since the call will not be exercised against him. So maximum risk is equal to stock price paid minus the call premium and upside capped at the strike price plus the premium received. Reward is limited to the call strike price minus stock price paid plus premium received, and break even is achieved when stock price minus premium received is achieved. So you can see the graph here, and from the graph you can see that profit from the covered call is in green. So it looks very much like a shield, like after a limit you have a call, uh, and you can make a profit from call, that is in the red you can see. Then you have a profit from uh, stock and you have a profit from call. Profit from call is in blue, so that you can see here. So actually profit from call, you are selling a call, so you are having this kind of figure, and then the if we combine these two we get a green figure. So this green figure, green line, that represents the covered call profit. So it shows that your profit is capped at 27 at the end. If our call premium is 15 for the stock, call strike price is 133 and stock buy price is 121. In such a scenario, our profit is capped at 27, and it otherwise it goes on decreasing up to -6, and it will go even below that in case we proceed, if stock degrades even down. So this is all the scenario that you can see here. We'll see this in more details, such scenario, when we'll do some practicals with this in advanced exercises. So let's come to the next one, is married put. So in the married put we see there is a strike price we have identified. So protecting their downside risk when holding a stock. So it is used when we are holding a stock and we want to protect the downside risk. So we are holding a stock. So when the for some of the environmental reason stock prices goes down, the stock will keep going down and down. So in order to absorb that shock we take put option. So put option will give a momentum and it will keep on increasing, and our downside risk will be kept on hold. So for that reason protective put is used, and that you can see here. So its overall result is like this. This final dark line is there. So that dark line sees the final result of the protective put. So coming to the bull call spread, in a bull call spread strategy, an investor simultaneously buys calls at a specific strike price while also selling the same number of calls at a specific strike price, so with the higher strike price. So both call options will have the same expiration date and underlying asset, but their strike price will be different. Because of that, it will form a situations where uh, mm, trader uh, um, will gain from a little rise in stocks and will lose from little little loss in stock, but ultimately it will be capped at both the end. Similarly, bear put spread is similar to that. Here, the investor simultaneously purchases put options at a specific strike price and also sells the same number of puts at lower strike price. Both options are purchased for the same underlying assets and have the same expiration date. Here also you can see that it is bear put spread. So if it is a bear market, slight bear, then in that case, if there is little loss in the stock, then it will give rise to profit. And if it is little, because we are expecting a bear market, but still if a stock rises, will be in loss. But both higher loss and higher gain will be capped at the end. So coming to the protective collar, we have the collar is good strategy to use if the investor is writing covered call to earn premiums, but wishes to protect himself from an unexpected sharp drop in price of the underlying security. So risk is limited, reward is limited, and break even is purchase price of underlying minus call premium plus put premium. So that way you can see this. The diagram is there, the calculation is also there. You can just understand how this protective collar works. Coming to long straddle, you can see the investor thinks that the underlying stock index will experience significant volatility in the near term. And because of the near term volatility limited to the initial premium paid and unlimited rewards. So with the upper break-even point is a strike price of the long call plus net premium paid, and lower break-even point is a strike price of the long put minus net premium paid. And you can see that the final long straddle profit is by this green one. So you can see if you are limited to lose, but there are both ways. If due to volatility either stock rises a lot or it declines a lot, in both the cases you are going to make profit. So in the case of longest triangle, it's little different, but it is also similar to that. Here we have similar as longest triangle, but it is longest triangle. So here we have a small parallel lines between the x-axis and the green chart that we have plotted. So with the green lines chart we have plotted, and the x-axis we have a small parallel lines also. So here the investor thinks that the underlying stock index will experience a very high level of volatility in the near term, and it is limited to the initial premium paid, and reward is unlimited on both the sides, whether stock goes down or stock goes up in both the cases. And the strike price of the long call plus net premium paid, and here the strike price of the long put minus net premium paid. So these are the break-even cases. So here also the calculation is given in great details, with the call premium, put premium, call strike price, put strike price. All these details are assumed, and based on that some calculation is done, and all the results are given with the long struggle profit potential also explained, so that you can visualize. Now coming to the long call butterfly spread, here when the investor is neutral on market direction and bearish on volatility, risk net debit paid reward difference between the adjacent strikes minus the debit. And break even point, we consider upper break even point as a strike price of higher strike long call minus net premium paid, and lower break even point is strike price of lower strike long call plus net premium paid. And you can see this is the net profit in long butterfly diagram. And here we have call premium 1, call premium for 2 and 3, then call strike price 1, then call strike price 2, and strike price 3, and stop at expiry we can see here. So all this we can see here. So with this we can see that long call butterfly spread is there, right? So that you can see. Now, coming to the next section, we will be discussing something like uh, examples of option trading strategy in some election events of like election event of 2014 when BJP won the election. Then some incident in which budget was passed in a parliament and it was favorable to stock market, and how long call will give rise to unprecedented increase in wealth in just 1 or 2 days. So those kind of examples we will see practical examples in some of the later sections. For now, this is all. Thank you.